there, Don. Let's talk about the health of the consumer and the impact on the market. Joining us for that is Krishna Memani, Vice Chairman of Investments at Invesco, and Mike Santoli, CNBC's senior markets commentator. You know, if you were to go station yourself at a mall, one of the bad ones, you'd think the yield curve was definitely right. You go to a Target, which is not at an anchor or one of the anchor tenants at a mall, and you think, oh my God, it's gangbusters. So it matters which retailer we're talking about.
Yes, but I think overall, the reason the U.S. economy continues to do as well as it is because employment is good, income growth is good.
Consumers are strong,
The consumer is strong. That's 70% of the economy. So if it wasn't for that part, we would be in a much bigger situation than we currently are. The part of the economy that is not working is capital investments, and that's driven more by trade than anything else.
Yeah, and it seems as if the consumer backdrop there's enough to go around for more than just Walmart, Amazon. I mean, that's the way the market is responding to Lowe's and Target. Basically tells you these were two big companies that are in kind of revitalization mode that still trade at a big discount to their huge incumbent competitor.
Right.
So that's what you're seeing, that gap getting closed a little bit today with Lowe's.
And shows that investments pay off. I mean,
if you had the scale, investments pay off, yes.
Right. For Target, I think their same-day delivery on issues, things like shipped or picking up in store, the same-day in-house pickup for all those things, I think that accounted for about half of the growth, almost half of the growth that they saw in same-store sales.
Right. So if you're already ubiquitous, you can take advantage of the current kind of retail environment and customer habits and all the rest of it. So you don't want to necessarily extrapolate these great numbers to say, wow, the economy as a whole is reaccelerating. It's just, yeah, wage growth is good. The consumer does not have a debt problem right now. I mean, all these things are tailwinds for the group.
I think the consumer part of it is where we are today. What looks in the future really depends on how we resolve the trade issue. It is still a central issue, and how the administration addresses this, I think, is going to be critical. If they don't kind of resolve this in a reasonable fashion over the next, let's say, 12, 14 months, then we are probably going to have a bigger problem.
You know, Walmart was able to raise guidance even knowing that the tariffs could kick in later this year. Now, obviously, those tariffs wouldn't kick in to the very end of the quarter. So maybe it's not a big deal to raise guidance this year, but I thought that was really aggressive and kind of bold to get out there ahead of that and say, look, based on what we know as of today, here's where we think it's going. And even with it, they're flexible. They can be hurt less than a lot of the smaller players.
So I think let's kind of focus on trade for a second, because that's the driver of that. What we are talking about here is tariffs, right? Tariffs means it's basically a fiscal consolidation. It's a tax on U.S. consumer. So if you see consumer growth or consumer income growth at a certain level, even with that tariff, you can probably project decent growth rate. And I think that's what they're focusing on.
So is the message from both Target and Walmart that if you have scale, you can push back on the manufacturing cost, saying you have to absorb some of the tariffs? We know they're going to be increasing into 2000, next year, I mean. And because of that, you've got, particularly in apparel, where I would think it really would manifest itself, I'm sorry, your margins are going to be less at the manufacturing level. Make them basically pay for half the tariff. Make the Chinese manufacturer actually pay for a portion of the tariff by cutting down on their profits. Well, which I love as a strategy.
I think the Chinese manufacturers are paying for it. If it wasn't for that, growth in China would have been meaningfully better than what it is today. But a larger portion of that is really being paid by the U.S. consumer. That is okay because consumer income growth is substantial and they can afford to pay that tax. But that cannot continue for a long period of time.
Well, so far it's working. These numbers are spectacular.
These numbers are spectacular today, but the point I'm trying to make is the tariff issue has to be resolved because it is a tax on U.S. consumers.
Let me ask another investment question. Should I start investing in the losers in retail with the assumption that these large winners are going to consolidate them?
Well, here's the thing. Well, I don't know about consolidate them. I mean, but it's such a tremendous separation.
Coach. Bad performance, bad execution. Good brand.
Dumb name change.
Yes, brands perhaps, because you're not talking about thousands of stores, right? You're talking about their brands, and they do have some kind of life outside of the four walls.
I think Coach is a niche strategy.
No, but the point is,
Kate Spade is the problem.
I think what's very stark, though, right now is if you look at Gap, Kohl's, you look at these very large, ubiquitous mall chains that trade, Macy's, that trade under 10 times earnings because the market has basically said, we just don't see a way out.
Some of them are at 7x. I mean,
that's Gap, that's Macy's, 5.
So I'm thinking...
You think that's a good deal?
But it hasn't
I
happened
think
yet. That's the problem.
Those retailers are value
private
traps.
equity.
They are cheap. They're like banks in a lot of ways, and worse because at least banks are making a lot of money. These guys aren't. I think buying retailers on the thesis that they will get consolidated, and that's how you're going to make money because they are cheap today. I think it's a little iffy strategy.
I'm starting to believe that executional excellence at the managerial level matters for Walmart, matters for Target, and maybe the management of a Gap wasn't as good. And the punishment for that is that they get taken out by better management teams. That happens in many industries.
Right, but you're buying the right to close hundreds of stores. I mean, you're playing defense no matter what you do. And that's why I think it's been very conspicuous that private equity, which was always a big player in retail, has mostly stayed away, even though the math works for the buyout.
You can't use leverage when you're shutting down half your stores.
Well, you wouldn't think so unless the stocks are cheap enough.
Yeah, maybe we'll get there. Because that's what this is starting to look like, have and have-nots.
Well, so I think you can say that about a large portion of the U.S. market where valuations are very, very cheap. And I would go back to banks. Banks are equally cheap, if not better value, because their profitability and at least their profitability growth trend is meaningfully better.
Is where money goes to die. They've been perpetually cheap for 3 years.
I thought that was autos.
No.
They died.
Now it's banks.
Banks are terrible.
But by the way, this is an interesting point because you talk about autos, you talk about banks, small retailers, all these areas that used to be, hey, the domestic economy is doing great, the Fed's cutting rates, the consumer is fine. You would normally have those trades work. But because of secular issues in a lot of those industries,
I think
those sectors are on the outs.
Retailing has always been about execution and strategy. Right. Companies that do well on that front will probably survive out of this chaos and probably do well. People who can't execute well and their strategy is flawed, I think it's a small world for them.